Hey everyone, welcome back to Corporate Decoder. If you thought today was going to be all sunshine and rainbows, well, buckle up, because we've got a filing that might just rain on some parades, or at least make us wonder what is really cooking under the hood. Today, we're diving into Hyperliquid Strategies Incorporated's quarterly report, a document that seems to be painting a picture of a company in significant transition, especially with a massive business combination and a whole lot of financial maneuvering happening. Let's kick things off by looking at the absolute core of any company's financial health, its profitability. For the period from its inception in July 2025 through the 30th of September 2025, Hyperliquid Strategies reported a net loss of over $1.2 million. Now, this isn't entirely surprising for a company that is just getting started and is involved in complex transactions. The bulk of this loss, $1,212,921, is chalked up to formation and operating costs. Think of it as the startup bills and the expenses that come with setting up shop and preparing for major events. And speaking of major events, a huge part of this report revolves around a business combination with Sonnet Biotherapeutics Holdings Inc. and Rorschach. This wasn't just a small merger, it was a significant event completed on the 2nd of December 2025. This deal brought together Rorschach, Sonnet, and what became Hyperliquid Strategies. It involved exchanging Sonnet's common stock for a mix of Hyperliquid's common stock and something called contingent value rights, or CVRs. These CVRs are essentially promises of future payments based on how certain company legacy assets perform over a 3-year period. It is like a bet on the future performance of specific parts of the acquired businesses. Now let's look at what this combination means for the company's structure. Immediately after the closing of this deal, Hyperliquid Strategies had a staggering 127025563 shares of common stock outstanding. On top of that, they have series of preferred stock which is convertible into a lot more common stock, and a bunch of warrants that can also be exercised to get even more shares. This is a lot of potential dilution for existing shareholders, meaning each share represents a smaller piece of the pie if all these options are exercised. The details of these CVRs are really interesting. Essentially, holders of Sonnet stock and warrants receive these CVRs. The value of these CVRs depends on the success of certain assets from the acquired companies within 3 years. This is a way for the deal makers to hedge their bets, giving former Sonnet shareholders a chance to benefit if those legacy assets do well. But it also creates a future liability and potential payout for Hyperliquid Strategies down the line. Then there is the advisor rights situation. Rorschach Advisors LLC entered into agreements, including an advisor rights agreement and a strategic advisor agreement, and received warrants. This advisor has influence with the right to nominate directors to the board as long as they meet certain ownership thresholds. They've also agreed to provide advisory services for 5 years. This suggests a significant ongoing relationship and potential for influence by this advisor. Looking ahead, a major development was the agreement on the 22nd of October 2025 with Chardon Capital Markets LLC. This is essentially a flexible financing arrangement where Hyperliquid can sell up to $1 billion of its common stock to Chardon at its discretion. This gives the company a runway for funding, but it also means they can issue a lot more shares, potentially diluting existing shareholders further, depending on how and when they decide to use this facility. The Sonnet Biotherapeutics Holdings Inc. merger itself involved a complex exchange. Each share of Sonnet common stock was converted into a fraction of a Hyperliquid share plus 1 CVR vested stock options, and warrants for Sonnet were also converted into rights related to Hyperliquid stock, with specific terms for in the money and out of the money options. This shows a very intricate financial engineering at play to consolidate these entities. Let's circle back to the balance sheet as of the 30th of September 2025. It paints a picture of a company very early in its journey. You see liabilities like accounts payable and accrued expenses totaling over $1.1 million. But the most striking item is the stockholders' deficit of over $1.2 million. This means the company's liabilities exceeded its assets, and because they had only issued 100 shares of common stock at that point, the accumulated deficit was quite large relative to the minimal equity. This highlights the company's reliance on future funding to become solvent. The statement of operations for the period is simply the net loss, which we've seen is over $1.2 million. It is important to remember this covers a very short period from the company's inception in July to the end of September 2025, and it is entirely made up of formation and operating costs. The weighted average shares outstanding were a tiny 92, leading to a per share net loss of over $13,000. This number is astronomical and purely a reflection of a very small shareholder base, and significant early stage costs. The statement of cash flows for this initial period shows essentially zero net cash flow from operating activities. The net loss was adjusted by changes in operating assets and liabilities, like accounts payable and amounts due to related parties, but it ultimately netted out to zero cash generated or used in operations. This makes sense given the company was still in its formation and pre-revenue stage. The cash balance at the end of the period was also zero, meaning all initial funds were likely spent on setting up the operations and preparing for the transactions. The company's management acknowledges the going concern issue, which is typical for early stage companies with significant deficits. They state that since their inception, they've had recurring net losses and working capital deficits. However, they also highlight that the capital raised through the transaction, especially equity raises through subscription agreements, has alleviated substantial doubt about their ability to continue as a going concern for at least 1 year. This is a critical point. The inflow of cash from this massive deal was what kept them afloat and provided the runway to continue operations. A significant risk they call out is their substantial dependence on the market price and liquidity of hype tokens after the transaction. These tokens are already subject to extreme volatility and limited trading. Their treasury assets are concentrated in cash and these hype tokens. This means the company's financial results and the value of its digital assets will heavily fluctuate with the price of hype tokens. Their success is directly tied to the success and adoption of the Hyperliquid protocol. This is a big gamble and a major exposure to the volatile world of cryptocurrencies. Now, let's talk about the stock itself. The common stock with a par value of $0.01 per S-share, trading under the symbol PER on the Nasdaq stock market LLC. As of the 5th of December 2025, there were over 127 million shares issued and outstanding. This is a substantial number of shares. And given the conversion features of preferred stock and warrants, this number could grow even larger. This specific figure, 127,025,563 shares, represents the snapshot of ownership right after the major business combination. It is the baseline for understanding how ownership is distributed and how much potential dilution exists from other convertible securities or options. This sentence really cuts to the chase about the company's future. After the big merger, their financial health isn't just tied to traditional business operations, but heavily influenced by the volatile crypto market, specifically hype tokens. This is a significant strategic pivot and a source of considerable risk. Interestingly, despite all the complexities and potential dilution, the company announced a stock repurchase program of up to $30 million. This is a common move to support the stock price, potentially signaling confidence from management or perhaps an attempt to offset some of the dilution effects in the market. It is something to watch closely as the program unfolds. So, what is the verdict on Hyperliquid Strategies Inc. based on this filing? This company is in a make or break phase. They've just undergone a massive business combination, bringing together multiple entities and a significant amount of capital, but also a lot of complexity and potential shareholder dilution. Their survival and growth are now intrinsically linked to the volatile world of cryptocurrencies, specifically hype tokens, which presents a very high risk, high reward scenario. They've managed to alleviate immediate going concern issues thanks to the capital infusion from the merger, but the long-term strategy hinges on the success of the Hyperliquid protocol and careful management of their substantial share structure. The stock repurchase program is a curious move given the dilution potential, and it will be interesting to see how that plays out against the backdrop of their crypto-centric strategy. It is a bold play for sure, and one that investors will be watching very closely. Alright, that is our breakdown of Hyperliquid Strategies Inc. Its latest filing, what is your take on these numbers and what they signal for the company's future? Do you think their crypto focus is a winning strategy or a recipe for disaster? Drop your thoughts in the comments below if this analysis was valuable. Hitting that like button really helps us out, and be sure to subscribe for more deep dives into the world of corporate finance. And don't forget to join our Discord community. The link is in the description, where we can continue this conversation and explore more complex financial topics together. Thanks for watching, and we'll see you next time on Corporate Decoder.